Another volatile week for Xerox holders and accumulators. The major news was the warrants. The distribution ratio here was a 1 for 2, so one warrant for every 2 shares, leaving us with a tidy warrant hold. To explain what a warrant is, or to explain what's going on, essentially, it's a warrant dividend here. False it as, or frame it as, mentally frame it as a special dividend if you sold the warrants, so it's easier to process and relate. So it also helps explain the further drop in share price, this recent price drop. It dropped another leg down, I'm sure you all noticed, and it would have freaked out a lot of people. So just as an ex-dividend drops the share price, so should a warrant dividend, right? It only makes sense for a warrant dividend to act like an ex-dividend. Obviously, many retail investors have sold their warrants or will be in the process of selling their warrants. We don't blame anyone who sold. Most people just don't experience warrants. What are warrants? All they are is just rights to buy at a certain exercise price. It's an option. In this case, for Xerox, the exercise price is of $8. So the warrants could have substantial value if the price action goes our way. In reality, as of now, existing holders of Xerox haven't really lost out. Dilution has not kicked in. We know the threshold of dilution. Knowledge is key. Knowledge is power. The threshold of dilution is $8. So those who have potentially lost out or who may be feeling that they have lost out are the sellers on the news of the shelf offering. I don't know if you recall, and I did do a video on this about 3 weeks ago, so sometime in late Jan. There was a shelf offering back then, right? Well, news of a shelf offering to the tune of 250 million. So that freaked out a lot of people, possibly a number of them thinking it was a dilution or a takedown of shares at such a lowly price. It wasn't, of course. It was just a shelf offering. Like I say, I've explained what that is, and just have a look at the past video in the archive. And don't forget, please do subscribe. But just moving on to the rest of the week, the rest of the update. There's a few bits and pieces here. So just to obviously carry on with this subject of warrants, we can now tie this all together. So that shelf offering was linked to the warrant issue, which we know has a strike price of $8. So theoretically, there's no major dilution or takedown till loftier levels either, i.e. $8. So it calms down the jittery shareholders. They can see what's gone on. There was selling pressure. You've naturally got people rushing for the doors, knowing that it's going to be an uphill struggle, uphill battle to get beyond $8 now, given that the warrant exercise price is $8. And the potential for mass dilution at that point onwards. So you're looking at people who've got cost bases of 10 or more. They may have capitulated upon knowing the warrant price. It would have been a bit of a downer for them. The volume profile, if you have a look, the volume profile shows a number of buys above the $10 range. As for the stock performance, in short, it's terrible. That's the word for it. Utterly terrible. You're down a quarter, right? You're down a quarter just for the month, for the trailing month. 25% down. For the trailing 12 months, you're down 3/4, 75% down. The 5-year trail, you're down 90%. And as for all time, so from flotation, you're down 95%. It makes grim reading. There's no hiding from that. As for me, what I'm doing is I'm just looking to accumulate more at this range and below, God forbid, if it goes lower. Not entirely sure how many can stomach another leg down. I'm almost at a full position, to tell you the truth. Right, if not already there, and I'm just nibbling. As for other bits and pieces, I did see a comment from a Xerox employee recently, which was quite encouraging, to tell you the truth. They believe in one of Lexmark's products. Naturally, if an industry insider is gushing over a product, it does mean you would expect it to sell well. Hopefully, it's got strong industry demand. Also, gleaning from the comment, it looks like they're really pushing for the IT segment. So they're pushing for cross sales into the IT services segment. That's positive. Hopefully, that's going to help push that IT services revenue. Yeah, and so, some of you may not be aware, Xerox has won a couple of good contracts of late. So they did win the NHS contract. That's our UK National Health Service. That is prestigious. So well done, Xerox there. They also got a supermarket chain in Britain. They won that contract. I believe, if I recall correctly, it was Morrison's. That's another UK based supermarket. It is a big name. So the NHS, definitely a massive name. Morrison's, another big name. They should be able to leverage those names to help win other contracts in the UK and Europe. The last bit of news is the short update. It didn't really go well for holders to tell you the truth. So I do recall seeing a short percentage of over 40% a few weeks ago, which was massive to tell you the truth. And I was quietly hoping for some sort of squeeze. It hasn't obviously materialised. Clearly, the shorts, they've been quite adroit here, and they've closed without upward pressure, too much upward pressure. And it's definitely working for the smart shorts right now, but you do get the feeling some of them may still get trapped. We'll see how it works for them. There's a current short percentage of 25%. Quick update on this: it's about 21% right now, not 25%. And to tell you the truth, from 40 to 20, it does start tempering the possible squeeze idea. And definitely expecting further shorts to close this month. I'd imagine they're gonna do this quite skillfully. Well, we'll see. Lastly, I want to touch on the free cash flow guidance for 2026. It was down as roughly 250 million. What I'm really hoping for, to tell you the truth, is I'm hoping for some sort of sandbagging here. I'm hoping that Steve and Co are sandbagging with this figure of 250 million. They've got 290 million in debt service charges for this year. It's a debt play, right? It's a debt play right now. It's about reducing maturities, which gives us shareholder value, and it gives us compounded value as ultimately, as they reduce the maturities, it reduces the debt service, meaning free cash flow will just start increasing. That's the name of the game here. That's a major focal point for Steve Brandozak and the board. As for the rest of Feb, expecting a strong finish for the month. You would think the sellers are pretty much exhausted now, or early next week they'll be exhausted, meaning the buyers will start stepping in.